Welcome back. You're watching Indian Open. Indians love burgers and wraps, especially when suited to the Indian taste buds, but not as much when discretionary spending is waning. McDonald's has therefore opted for value packs and combo meals, not only to keep the consumers loving it, but also to ward off competition from Burger King. The bets had some success, with same-store sales growth increasing in the last quarter, but it's nowhere close to the double-digit numbers clocked till about a year back. So what's McDonald's franchise owner Westlife planning to do to get back to the high teens growth path? Let's get the company's vice chairman, Mr. Amit Jatia, to join in and talk about all of that and more with us. Mr. Jatia, thanks very much for taking out the time. So Q2, despite the demand sentiment being slightly weak and the demand environment being slightly weak, was okay with regards to the same-store sales growth, which came in at 7%, obviously nowhere close to the teens that we're talking about, but you did okay on a sequential basis. Margins saw a sharp expansion as well. Just talk about, what the game plan is going forward in this current environment.
Sure. I mean, if you think about it, it's been 17 quarters of positive same-store sales growth. And if you look at like the first quarter of this 17th quarter, we've grown same-store sales by 58%. So I feel that in a very volatile market, for a brand to be able to consistently deliver 17 quarters itself shows that the long-term foundation of what we are trying to do is quite strong to be able to get consumers in. And if you look at the 7% in that context, you'll realize the power of the 7%. Because, for example, now we are 58% more than we were 4 years ago. So to grow the 58% by even 7 or 8% in the next quarter or in the next year is quite a daunting task, because you have to maintain that base as well. So I think we are quite proud of what we've been able to do. And this is obviously built on the foundation of our long-term thinking. In 2016, we came out with Vision 2022, and we have solidly worked hard on keeping that as the primary goal, rather than sort of focusing on sort of ups and downs in the economy. And the crux of all this is really building new occasions for the consumer to use the brand, whether it's breakfast, whether it's coffee, whether it's consuming outside food at home, and so on. So that's really what's worked for us in the last few years.
Mr. Jatia, just talk a little bit more on what the focus is going to be with regards to making new investments. I mean, in terms of, you just spoke about the same-store sales growth, but with regards to store expansions, whether or not you're going to indulge in further promotional activity, where is the price point that the consumer is getting most attractive to? Talk about all of those factors.
Sure. I mean, the QSR market in India and the Western fast food market in India is still very nascent. If you look at the total size, it's only $1.8 billion to $2 billion. But the good news is that the growth in the sector, even at this point in time, is at least single digit. So while we may complain about single digits, the fact is that most other industries don't even have that. Now, if you look at that backdrop, we have really two big jobs to do over the next 3 to 5 years. First and foremost, obviously we are under-penetrated. I mean, 300 restaurants in all of West and South, clearly that's a big job for us to get to the 600 to the 1,000 restaurants so that we can be convenient to more and more customers. So that is one big job, and you will see that even through the period of 2014, 15, 16, 17, when things were really, really tough, same-store sales were down, we opened over 100, 120 restaurants. So you will see that continue from us, and I don't see that stopping in the foreseeable future. So that is one big part of it. The other part is that when you are in the business of retail and you have consumers coming in and using you with so much competition available and around, I feel no retail brand has the option but to reinvent themselves, in fact, every day. And that's why I always say that we will evolve every day, and over a 2 to 3 year horizon, you will not recognize the brand that you saw 3 years ago. So if you think about it, while 2 or 3 years ago, the conversation was all around a McCafe re-imaging, today the conversation is about giving consumers an experience of the future, where they can order on a digital platform, sit down on the table, get table service, and therefore their experience gets elevated. Along with that, you will see us continue to grow the coffee business. We feel that we have a tremendous advantage of having really great locations and being able to give handcrafted barista-made coffee in this environment has really resonated with our consumers, and it has added a new occasion for use for McDonald's. So you will continue to see growth in this area. Value, of course, will continue to play an important role. So let me sort of deconstruct value from a consumer point of view. In India, the snacking market is something that we expect to grow really, really largely. And we think that the brand fits in quite nicely with our penetration, where if the consumer wants a quick meal, McDonald's should be their first choice. And therefore, the McSavers combos play that role in the consumer's life. And what it does for us is it builds McDonald's through the afternoon day part, through the snacking day part, which is between breakfast and lunch. So what you will see if you kind of zoom out and look at it holistically, that we are trying to capture every consumer's occasion of use, whether it's breakfast, whether it's coffee, whether it's a snack, or during lunch and dinner. Again, from a lunch and dinner point of view, as we are trying to build that business, you saw us introduce rice because that's a more filling meal for the consumer. You will see us take leadership on the wrap side. And of course, the key is to keep all this affordable. And therefore, you will see us bring value that is unparalleled for the consumer. So, this is the journey that we expect to see over the next 3 to 5 years. In our Vision 2022, we've stated this quite clearly, that the restaurant base will be between 400 to 500. We will have about 300 to 350 McCafes, about 350 delivery points, and of course all the things I just talked about from a menu point of view. So that's what you can expect to see from McDonald's over the next 3 to 5 years.
Right. You've also managed to have a strikingly good EBIT margin for Q2, but your target for about 13 to 15% EBIT margin. Is that also on track? I mean, you have to reinvent yourself in terms of the product mix, and you've done that, and that's what's aided in this quarter. You've had, good cost management despite input cost inflation moving up. So how do you intend to do that and keep the pace going?
Sure. I mean, for us, it's all about step by step, and we don't believe in doing knee-jerk reactions. So if you look at the last 3 years, we've been able to improve our EBITDA margins by about 120 basis points a year. And I think if you look at the trajectory this year again, we have kind of delivered a bit more than that. So we are quite confident that you will see at least 100 to 200 basis points improvement year on year. And that's primarily driven because of one, of course, the product mix, as you rightly pointed out, but also tremendous focus on keeping cost structure tight. The whole idea is that when you grow sales by, say, even same-store sales by, say, 7% or 8%, you got to keep the cost growth to about 2 to 3% so that the incremental 5% goes straight to the bottom line. And as I have explained earlier, once we cross the threshold of about 6 to 6.2 crores per restaurant per year, the flow through to the bottom line continues to increase at a much higher and, in fact, a phenomenal pace. So we shared that in one of our investor presentations, I think a couple of years ago. As we are closing into this threshold sales number, you will see us finding it a little bit easier to continue to get this margin growth going, which is what we sort of factored in our Vision 2022. So yes, I'm quite happy to say that we are quite confident of delivering our Vision 2022 with respect to margins as well.
Amit, good morning. Neeraj here. Would you be able to give us a breakup of how your metro versus non-metro store breakup is, and if the same-store sales growth is disparate between those two geographies, if I can loosely use that term?
Sure. I mean, I know I hear a lot about rural demand not coming through and it's more urban, but to be honest, I don't see that, at least in our business. We do have restaurants in reasonably small cities like Nadia, Mehsana, Bharuch, Kolhapur. But from our point of view, we are not seeing that the non-rural areas demand or same-store sales is stronger than the rural. I don't know if it has to do with QSR and Western fast food, but for us it's reasonably even. We don't share individual breakups, but I don't see any trends that show me that rural demand is dipping, at least in our business.
Okay, so demand is not dipping and the same store sales growth would be high there too. Part two of my question therefore would be, would you believe that as you expand more into the non-metros, because you would have reached a critical size or critical mass in metros any which ways, that your margins would anyway see a bit of a leg up because the costs of employment as well as the rentals would be low there, and it might be a bit more aspirational, a product or a place to go to in tier 3, tier 4 as opposed to tier 1 or metros?
No, so I mean, I see it slightly differently, to be honest. I believe that real consumption lies in the 6 or 7 key cities. There are some other smaller cities or what we call core cities, like a Surat or a Baroda, that also have good demand, and therefore 60 to 70% of our growth is going to continue to come in these cities. So while the cost structure in these cities is higher, but the average unit volume in these cities is also very, very high. Versus smaller cities, while the cost structure is lower, but then the average volume also takes a little bit longer to build. Yet at the same time, in our own way, thinking about a marathon or an inside-out growth strategy, we've been consistently been adding new cities to our mix. So for example, we opened Raipur, most recently Nagpur. Now we have 3 or 4 restaurants in Goa, while 3 years ago we had 0. So, but once we get into a city, then we tend to go and own it. So if you imagine in a small place like Vapi, which is a little bit north of Mumbai on the way to Gujarat, we have 2 freestanding drive-thrus across each other, and both are doing really quite well. So I feel there is a method in the madness. And for example, if I look at Mumbai, we have the largest base of stores at about 92 over our similar competitors in the burger business, and we expect that 92 can easily go to 150 to 200. Again, while Mumbai is very hard to penetrate, but because of the strength of the brand, we are able to see much higher average unit sales, and therefore we are able to absorb the higher cost and actually make good money in these cities as well. So a tougher job, but I think that's the way to do it.
All right. Mr. Jati, just last few questions before we wind down on this interaction. Firstly,
sure.
What's the competitive landscape looking like in terms of costing and making sure that you have more of the deals, more promotional deals coming up, and how would you tackle that? And second is, how do you view the pressure on dine-in segment and the shift towards delivery, and how do you think that will shape up in the upcoming years?
Sure. So firstly, to be honest, I truly believe that. I think competition is really great. And I feel that if we did not have competition, we would not be on our toes and we would not be our best for the consumer. And therefore, I feel that at this stage and development of the Western fast food business, competition is actually growing the market. Obviously, we have to make sure, as I mentioned earlier, that we continuously reinvent ourselves. We are cost competitive. We keep the consumer experience at the forefront, and we essentially ensure that our product offerings to the consumer is in line with their expectations and they resonate with that. And I love that about it, because otherwise we would have never accelerated experience of the future and all the menu work and all the things I talked about in the past. So while it is competitive, we deal with that globally, and we feel taking it head on is actually good for the business, for the industry, and for the consumer. From a delivery point of view, I have always maintained that it's fantastic. Just think about it this way, that if that demand and that business was not available, we would have lost almost $1 billion of market of eating outside food at home. So on the big picture point of view, it is great to see that consumers want to eat outside food at home, and aggregators and apps like ours also make it convenient for them to order. The question therefore is that when that demand is there, you got to fit your business model to capture that demand. And our internal target has always been that, okay, this business is there. This is the reality of the cost structure in this business. How do we ensure that it works for us and we make money while owning that market? So from my point of view, I think that's growing well because it's a small base. while the larger base of in-store dining, of course, has a little bit of pressure right now due to the headwinds, but I expect that to continue to grow at least 7 to 8%. And I feel that at least McDonald's will play in both through all the initiatives I talked about. For example, if you look at coffee and McCafe, we are taking it from 200 to 300, and that's an in-store strategy more than a takeaway strategy or a delivery strategy. Meanwhile, rice can be delivered very nicely over lunch, and so does breakfast. So I think we have to factor that that's a new business opportunity, and we have to play both sides equally well. So that's my take on it. I love it actually, and it again forces us to fit the business model into the growing consumption for outside food at home.
Right, Mr. Jatia, it was a pleasure chatting with you and getting your thoughts on the platform. Thank you so very much for joining us this morning.
Thank you for having me.
Right, so Vision 2022 is on track, and that's a good thing.
Well, let's wait and watch whether the stock gives the returns or no to shareholders. But a set of stocks which likely are becoming favorites with a lot of portfolio managers is real estate. The growing pile of unsold inventory and the overall growth slowdown notwithstanding. But yeah, all of this is bad news for any sector, especially so when it's housing. Ticket sizes are larger, prompting buyers and investors to be doubly cautious before making a purchase on at least the premium housing. How do you approach investing in this space? Let's get in somebody who looks at this very, very closely. Murtuza Arsiwala, Associate Director in Kotak Institutional Securities, joins us right now on the show. Murtuza, Neeraj here, good morning. Always good having you. Thanks so much for joining in. Murtuza, I hear this argument a lot that if indeed the sector is contributing 9% to GDP, its presence in the market cap cannot be as low as 2% or 1.5% or thereabouts. Is that a reasonable argument to make?
Well, I think looking at it slightly differently and why the representation in the equity markets is so low is it's traditionally been a highly fragmented sector with a very large tail. I mean, if I look at my listed peers, maybe on a combined basis, even today, after an element of consolidation showing in, you'd probably be representing about 15% or so of the overall sales in the country. So still a highly fragmented sector with a large tail, and therefore not enough representation in the equity markets. Guess that changes with a lot more consolidation, which means the organized and more so the listed players, the larger players with access to capital, sort of gaining more in terms of market share, and that reflecting in the size of the companies. Also, the other piece being the commercial real estate, which is now sort of, while still early days, has found itself a sort of entry into the capital markets through the REIT structures.
Okay. Well, the other question then therefore to ask Murtuza would be, how do you approach investing in this pocket? Would the models like the ones that Godrej Properties has adopted be the one that will actually gain more traction? Or the recent change in norms of revenue recognition might help a company like DLF because their numbers might start looking interesting as well. So that's the other bit. And whether or not some of these mid-sized players can actually become large, because the market cap diversity is also fairly stark. DLF trades at northwards of 50,000 crores market cap. The next largest to my mind is Godrej Properties with less than 25,000 crores. Oberoi is sub 20,000 crores. Prestige is at 11,000 crores. Murtuza, with all the permutations and combinations, what do you think is best placed? Because I think there are 2 or 3 distinct models that is coming out, right? One is this whole commercial lease model and embassy REITs out there, or certain other players like DLF which have got that model. 2 might be a kind of business model that Godrej Properties is trying to champion, which is don't go out and own the land bank, but try and enter into this JVs with landowners and try and do a high IRR development. Who do you think benefits over the medium term?
So I'd say they're different sort of businesses. So if you look at the leasing business, it's far more capital intensive, but you're essentially owning in a way perpetuities. They're annuities which will continue to grow at a modest pace, and it's found its sort of niche in terms of the kind of investors are looking at the commercial real estate space. I mean, if you look at global real estate investors, they tend to be more aligned with this kind of leasing model, and more so through the REIT structures. If you look at the development business, and if you look at the development business within that, if you look at the joint development agreements where you don't necessarily own the land, it's obviously a far more sort of IRR accretive. So, most developers are going down that path. Godrej Properties initially had gone through the entire development manager route as well, which is essentially near no capital invested sort of an investment vehicle. But over a period of time, they're realizing that there is a lot more sort of skin in the game for Godrej Properties with not enough sort of absolute value creation, and sort of slowing down and going more through the joint development agreement. So I think a joint development agreement works well. However, through legacy, a lot of real estate developers have legacy land banks. And for them, having full control and a low-cost land bank that they have to monetize does not require them to go through the joint development agreement. So it's not a one-size-fits-all kind of a situation. It's a function of what the land prices are in a particular city, micro market that you're looking to develop. Do you already own the land? So there is no perfect answer. In terms of between the commercial versus development, I mean, development's a faster sort of cash turnaround story. Development is a more sort of patient, long-term sort of story. Each has its set of investors, return profiles, and risk. From the listed space, there are players like Prestige, Brigade, which are there in both sides of the business, Oberoi Realty as well. Whereas there is an Embassy, which is a pure play sort of commercial. DLF has a bit of both, though a larger contribution does come in from their commercial business. So it's not a one-size-fits-all. Different companies have adopted different strategies in terms of their land banking, in terms of their investment in annuity businesses, in terms of their development business.
So what are you more bullish on, Murtuza? Let's not take a 6-month view. Let's take a 5-year out view.
See, the commercial business is going through a fantastic cycle. I mean, if you look at where Bangalore is today on the leasing business, 5% vacancy, low single-digit vacancy, clearly there is enough room for them to grow, right? Again, it's a more long-term sort of a story. So funds looking from a near-term perspective may not be. Development business is good. There is a lot of consolidation happening. It has become more capital intensive than it traditionally was through the changing regulations, etc. If one were to look at a more sort of 12 to 24 month perspective, the clear valuation gap today is with Soba. However, I think most of the listed players will benefit through this entire consolidation theme. So the consolidation theme is for real, very strong, and where you started off essentially saying that the representation of real estate in the markets vis-a-vis the economy is very small, and I think that's about to change. So it's just about choosing the management, a player that you wish to back. But I think most of the organized players with access to capital will benefit, where you will see hopefully that 10-15% market share for the organized segment growing substantially maybe 5 years down the line. So for me, from a 5-year perspective, you got to be in this sector more than sort of nitpicking which is the player that you want to back.
Murtuza, good morning. We were speaking with Mr. Lodha just a few days ago, and he was talking to us about how the premium residential market and the prices out there and the pickup out there is likely to happen pretty soon. Demand is likely to come back even for the premium residential market, aside from the fact that affordable residential is still doing well. In light of that, when one has to look at investing into developers purely focused in residential development, does one start looking at the ones catering to these premium markets, or just affordable housing, which has been doing well up till now, tried and tested, is the one to back right now?
So, tricky one. Both have their pros and cons. Clearly the velocity of sales in the premium segments died down substantially, and there is be it a Lodha, be it even Oberoi with 360 West, if one were looking at Mumbai. DLF, interestingly, while in the more premium sort of ticket size category in the NCR region, has been doing fairly well. So it's a tricky one, but if I were to, the more mid segment, mid to affordable segment clearly has a very high velocity of sales, which means your cash churns pretty fast. And that is where bulge of the market continues to be. The premium segment, people will find their niches like DLF, and it's a more higher margin product. So you may not get the scale that the mid segment gets you. but you get the margin. So it's really, again, one over the other, but I'd rather go for velocity of sales over the margins with a low velocity of sales.
Feel consolidation is done, much of it is already done with, or do you think there's still more to come where still more weaker developers will move out, ceding market share to the larger developers?
I think we're just at the start of it, to be honest. I mean, it's been, if you look at the trends, I mean, if I look at the, let's say, last 3-4 years, you've seen the market shares of my coverage universe move from about, let's say, 8% to about more like 12 to 15%. But you're only at about 12 to 15%, you know. So I think there is still headroom for a lot more. Given that the development business has become more capital intensive, the consumer, on the other hand, has become more demanding. He wants better quality product, more timely delivery. All of that requires an element of better sort of project management skills and access to capital, which is what is weaning out a lot of the tail essentially from the system.
Murtuza, we'll leave it at that. Thank you so much for taking the time out and being with us and giving us your thoughts. I love the point that he made. Instead of nitpicking as to where do you want to be in, choose a good player and be in the space over the next 5 years. It might be a place that might give you enough and lucrative returns.
Yep.
Let's wait and watch if that happens. For now, the market's about 0.25% in the green. It's a wrap on this leg of Indian Open from Devina and me and the team that put this show together. Thanks so much for watching. Stay tuned. The FNO show takes forward the action on the other side.